Good afternoon, everybody. My name is Anthony Kazazis, and I am the director of the NYC as well as the network group. We're also soon to have a new company called One NRE as well that will allow us to have webinars throughout the United States. I want to thank everybody for registering for today's Multiply Your Wealth with Multifamily. This is a webinar sponsored by RCN Capital. RCN Capital LLC was established in 2010 to provide time-sensitive bridge financing to real estate investors to fund the purchase of non-owner occupied residential and commercial properties, provide bridge loans, and provide real estate backed lines of credit. Formed towards the end of the recession, RCN Capital has benefited from a turbulent housing market in which many real estate investors see great opportunity. A lack of liquidity in the credit market and increased regulation of banking industry has restricted conventional financing as an option for investors in fast-moving and competitive real estate markets. As the nation's premier private lender, RCN Capital helps fill this void. Today's webinar is the multifamily space is ripe with the opportunity for investors in 2022. And now is the time to take advantage of them. Today, now, with this webinar, the RCN Capital team will discuss current and past multifamily trends, as well as what it takes to finance a multifamily deal scenario. Today, you'll learn how to evaluate your multifamily deals to ensure success and increase your profits. They will also touch on the upcoming commercial lending trends and how to capitalize on them, what types of financing are available and how to qualify for the best terms. Minimum FICO score, cash flowing properties, are lease agreements in place? What are the indicators of a good investment property? Red flags, quick turnovers, similar properties in the area. What is the ideal property for private lenders? Multifamily trends then and now, funded multifamily scenarios, examples. Our panelists today are Hunter Ramsey, Director of Multifamily Finance at RCN Capital, Connor Hibbs, Loan Officer, RCN Capital, and Alan Johnson, Director of Originations at RCN Capital. Hey, welcome, guys. Why don't we start off with Alan Johnson and just give us just a quick description of a little bio on yourself and what you do at RCN.
Sure. Like Anthony said, I'm the Director of Originations at RCN Capital. I've been in lending for about 25 years. I've done subprime, conventional, and now doing a little bit of private lending. For the past 4 years, I've been with RCN Capital and originating all kinds of properties, but primarily doing a large amount of 5+ units, whether it be long-term, short-term, conversions in the tri-state area. So very successful at it, extremely knowledgeable when it comes to these types of properties, as you'll find with most loan officers with RCN Capital. But it is a great opportunity for all of us to earn a little bit more money, get those higher loan amount type loans on the books. But it's something a lot of brokers and correspondent lenders are taking advantage of these days. And we want to make sure we share those experiences and successes with you folks today.
Thank you, Alan. Hunter?
Yeah, my name is Hunter Ramsey. I joined RCN in 2021. I've been working in the lending industry since 2011, doing bank balance sheet financing, CMBS lending, and working on the private lending side of things as well. I joined as the Director of Multifamily Finance and really work on all things multifamily here at RCN, doing our term lending as well as our bridge finance program.
Thank you, Hunter. And Connor.
Hi, yes, my name is Connor Hibbs. Been with RCN for getting close to about 2.5 years. Originally, I was with business development, so working with a lot of new brokers, new borrowers, going to a lot of different trade shows and events, especially over the last year. So I've hopefully been able to meet at least a couple of you out on the road. You have. please mention it. I'd be more than happy to connect to you again afterwards. But yes, I've recently moved into the loan officer position. So I've really just been hopefully trying to catch up to Alan eventually, but that's definitely going to take a little while as he's really established himself there. But yeah, really, I've been working with RCN for a while, and I look forward to working with them even more and getting to meet more and more of the brokers and borrowers over the course of that.
Great. Thank you, Connor. And I know we've had you on in the past, and you gave some great, definitely some great presentations on especially the Burr. I remember the Burr presentations. Guys, at this point in time, I am going to disappear. I'm going to let you guys speak. Ladies and gentlemen, please, if you have any questions, please put them into the Q&A section, not the chat sign. We will upload information on how to contact Alan and Hunter and Connor after this presentation. So at this point in time, without further ado, ladies and gentlemen, Connor Hibbs.
Thank you very much, Anthony. Yes, so hello, everybody again. My name is Connor. I'm joined with Alan and Hunter. So really to start off, I'd like to give you all just a little bit of a background about RCN Capital, what it is we do and who we are. So we are a national direct private lender. We've been around since about 2010, and we are a leader in the industry for fix and flips and rental loans. We do also offer bridge loans as well as ground up construction loans. So if anybody has any questions or scenarios regarding those, please feel more than welcome to reach out to myself, Alan, or Hunter. We'd be happy to talk over your deal with you a little bit. So we do have access to multiple sources of capital here at RCN Capital. Really what that means is we don't see ourselves running out of money anytime soon. Working with us, it's not going to be an issue of being capped out at 5 or 6 deals because we don't have the funds to be able to continue funding you. That's not going to be an issue here with us. So the more deals, the merrier. We implore you to try to get us to run out of money. So we do our underwriting in-house, and we do that for a couple of reasons. So one of those reasons is going to be the flexibility. So what I mean by flexibility is if we run into a scenario where perhaps the DSCR, debt service coverage ratio, is a little bit close, perhaps we're coming close to a contract date, this is an area where having our underwriters in-house allows us to reach out to our internal team and say, hey, is this something we can get an exception on? Or this deal needs to close by, let's say, Friday. Is there anything we can do to help speed up this process? So having those underwriters in-house and having them internal really allows us to have that conversation in a different way than if we were to use a third party to get that done. Now, we have funded over 13,000 transactions since we've been around, with just about 4,900 of those coming last year. We have been seeing really rapid increases in the growth of our company since we've been around. Last year, we did roughly 1.2 billion in origination. The year before that, 2020, the COVID year, that year we did about 530 million. We did just over 500 million the year before that, and then about 260 prior to that, and around 120 before that. So really, with the exception of that 2020 year, we have been roughly doubling each year in originations. Now, we do also offer loans regarding 1 to 4 families, not just the multifamilies that we will be talking about extensively today. And as I mentioned previously, we do mostly focus on those fix and flips, rental loans, bridge loans, and ground up construction loans. So if you're wondering where you would be able to use these RCN loans or where your clients will be able to use them, everywhere on this map that you see in green is an area in the country that RCN Capital is able to lend. So we do currently lend in 44 out of the 50 states, with those exceptions being in Alaska, Nevada, Minnesota, Vermont, and the Dakotas. Now, largely the reason why we're not able to lend in these areas is that we didn't purchase a license because there's just not enough volume to support it. Really more so with the Dakotas and Alaska there. However, with some states, as I'm sure you all noticed Nevada being on there, and probably thought, well, what about Las Vegas? So with Nevada and a little bit with Minnesota as well, the reasoning why we are not able to lend there is due to pretty strict licensing requirements. So just to kind of scratch the surface for at least Nevada's, some of the lines that we would need there would be a brick and mortar building as well as a resident of the state. So once again, everywhere on this map that you see in green is an area of the country that RCN is able to lend in. So if you've got a borrower who's looking to purchase a property in Florida and refinance another one in Texas, we are the lender for you. And now moving on to Hunter with a little bit more information about our multifamily programs.
Thanks, Connor. I'm going to walk through the general parameters of our programs and talk a little bit about our 30-year term program, and then Alan will talk through our bridge lending program. For our programs, we can do purchases, refinances, and cash out refis. For our 30-year term program, the properties are typically fully leased, occupied properties, generally require a 90% occupancy. We have our bridge lending program, and we can do those as stabilized bridge or bridge loans with renovations, which is what you would typically see. For our stabilized bridge program, generally the rehab that's going to be done, if any, is less than 5% of the value of the property. Typically, those properties are leased or mostly leased, and sponsors are looking for a temporary loan to bridge to permanent financing. We have our bridge program with renovation financing, where we can typically finance the purchase price of a property and then finance all of the renovations as well. Lastly, we have a ground up construction program too. We won't cover that in detail today. We're really just going to focus on the term program and the bridge program. In terms of property types, we can lend on 5+ unit multifamily properties, so anything with 5 or more units for one property, and mixed use as well. For the mixed use, we're typically looking for a majority of the space to be residential, so 51% or more residential space, with the remainder being retail or commercial office, and typically like to see 70% of the income coming from residential space as well. In terms of our long-term program, we think this is a really great program for small balance multifamily loans. The term of the program is obviously 30 years. We also offer a variety of amortization options for the loans. For 5 to 8 unit properties, we can actually do a fixed rate, fully amortizing program. So that's a full 30-year amortization fixed rate. For mixed use properties and 9+ unit properties, we have hybrid ARMs, which are a 5, 7, or 10-year ARM. That can be a full amortization with those ARMs, or a 5, 7, or 10-year interest-only period followed by a term out of the amortization to maturity. For loan amounts, we can start at just $250,000, which is a really great option for some of your smaller balance properties, and go up to $3 million, or in some cases more than that as well. In terms of the general program requirements, we do underwrite to the cash flow of the property. For any of your top markets, an example being Charlotte, Houston, Miami, Chicago, we can go down to a 1.20 underwritten debt service coverage ratio. For a smaller market such as Fayetteville, North Carolina, Boulder, Colorado, Savannah, Georgia, we do require a 1.3. And for a very small market, examples being Charlottesville, Virginia, for example, we do require 1.40 DSCR. We follow the same Freddie Mac small balance market tiers, where they have a tier based on populations in the MSAs, is what we use there. In terms of the value per unit requirements, we have a value per unit. We like to see at $50,000 a unit, but we can go down to $35,000 with RCN approval, really just depending on where the property is located and the quality of the property. The main reason that that parameter is there is just to ensure general property quality. In terms of escrows, you're going to see a very similar requirement as we would have for our 1 to 4 family properties. We just escrow tax and insurance. In terms of a few talking points for our programs that we feel is very competitive in the market versus the competition that you would see for these types of loans, as I mentioned, we can go down to just a $250,000 loan requirement. So it's a great option for deals that are too small for agency financing, or maybe too small for your local bank financing. We have low fees, quick closings, and less documentation than you would see with an agency loan or with a bank loan. In terms of our fees, for example, we do all of our legal work in-house. So our legal fee being under $1,000 is much less than you would see on a multi-million-dollar loan for a company that uses outside counsel that would be in the thousands. In terms of occupancy requirements and operating history, we do like to see 90% occupancy, but don't have stringent requirements on looking at the historicals. Agencies typically require 90% occupancy for 90 days with documentation for that. So we have more flexibility there. Lastly, we have options for non-recourse lending that sponsors aren't going to always see with their local bank. So we can do non-recourse lending typically with a 5% leverage reduction. And we also have options for foreign nationals as well. And with that, Alan is going to speak to the bridge program.
Thanks a lot, Hunter. The long-term product is pretty cut and dry. It's a great program for our investors to get out of these, smaller bridge loans for their multi-unit properties. Our bridge loan product, in my personal opinion, is second to none in our industry. Just to cover a few key points here, loan terms, 12 to 18 months, we can go to 36 months, depending on the project. So when we get into our bridge loan program, the project itself makes a big difference in how we're going to put together the terms of the loan. So just like the 30-year, we have a minimum of a $250,000 initial advance. So the funded amount at closing needs to be $250,000, and then whatever the rehab budget would be on top of that. We have a minimum $35K per unit as an as-is value, with a $50K per unit on the rehab after repair value. Again, going back to Connor's initial conversation around our underwriting being internal, you're going to see a lot of different program guidelines in this, many of which we do have exceptions to. So you may come across some of these particular guidelines and, maybe you say, the minimum initial advance is only $235,000. It's not going to qualify. It's not to say it's not going to qualify. It's just something we're going to need to send up and try to get an exception for, which we do. Hunter knows I just sent one over to him the other day and got an exception for the minimum initial advance being less than $250,000. So there are opportunities here. What I would say is anytime you get any of these loans, always bring them to us. Let us vet it out first and take a look at it. But these types of loans, we can go up to $10 million, which is a tremendous window for all of us to make a lot more money. So just going back to the rehab loans on the 5+ units, you're going to see, especially in areas like New Jersey, New York, just the tri-state area, you're going to see some things where you're going to be looking at doing condo conversions, converting, maybe 3, 4, 5 units into 10 or 12 units by going up and back and out, and just adding units. So there's just a great opportunity to make money in these areas on rental income by adding more and more apartment or units to the property, because the rents are so high in those areas. So we're very proficient at doing these. With these types of bridge loans, we can go with a regular light rehab type of bridge loan, we can go up to 80% of purchase, 100% of rehab, not to exceed 70% of our after repair value. When you start getting into your more heavy rehabs, like the condo conversions or the conversions where you're adding more units to the property, you might see more of a 75% of purchase, 65% ARV. But those opportunities are there, and you're going to see more and more of that stuff happening with, there's not a lot of land to build and so forth in those areas. So people are building and they're creating more in the building that they have. So keep that stuff in mind. Those things are there. You'll probably hear a lot of it, but don't be afraid to tackle these things. They're extremely profitable. And with the right lender, you're going to be able to get through these things pretty easily. A part of our job is to, if you're not used to these types of programs, whether it be a conversion or just a 5+ unit itself, that's what we're going to be here for. We spend a lot of time training, walking you through the process, making sure that the client understands that you understand what's going on each project. So don't be afraid to bring these to us, even if they may not fit these guidelines that you're seeing today. We might be able to take a look at it for you. If not, refer you to someone that we know that might be able to do it for you. A few tips and tricks that that we kind of put together here, just to help kind of look at what are the red flags, things to look for. I guess the process of doing a 5+ is very different than a 1 to 4 family. So you're going to be looking at much more due diligence. You're going to see environmental reports that need to be done, feasibility studies if it's a heavy rehab, situs reports, which is just a large desktop review of a commercial narrative appraisal. The commercial narrative appraisals, which if you haven't done these before, they're fairly expensive. They take much longer to do. These are the the kind of the MDs of the appraiser world that are doing these things. So keep all these things in mind. You're not going to have a 3-week turn time on a rehab loan. It's going to be more of a 6-week turn time, just because it's going to take, say, 18 business days to get the appraisal back, which is almost a full month. So our underwriting and our process on our end is very quick, but the due diligence that goes into these types of loans are very different than what you're going to see on a 1 to 4 unit. So Hunter, I'm going to have you talk to the first couple here on what are signs of good investment property and things of that nature.
Sure. In terms of good investment properties, from our perspective, we're really just looking for 2 things. One is looking at the market that the property is located in. Whether it's a term deal or a bridge product, we want to understand if the units can be leased very easily, if the market has strong occupancy, if it's in a good location. And then for the property itself, to understand how the cash flow looks at the property. And if it's a bridge loan, how do the current rents compare to what we think the property's rents will be after a renovation, to ensure that once a renovation is completed, a property can really be put on the market to have its units leased back up in a fair amount of time. It's really the biggest thing that we're looking for there. Anything you wanted to add there, Alan?
So when we do figure these numbers, so if we're doing a long term, we're going to really look at, what is it generating now? We'll also look at what the appraiser anticipates it to generate in a fully stabilized environment where you might have new tenants. On the fix and flips or the fix and holds, we're going to be looking at what it's going to be generating for income after repair. So when it's fully stabilized, we're going to be looking at the income at that point to qualify these loans. So every single one of these files that you're going to do is really going to be based on income. I mean, income is going to be the most important thing, because with a multi-unit property, there are very few people that are buying these to rehab them, then sell them. It's generally to hold them. So you don't see a huge increase in value with a rehab budget on a multi-unit property. It's generally you're kind of rehabbing those units to bring them up to par for someone to be able to go in and rent them. So when we look at those properties, we're really looking to see what it's going to be once you've purchased it and you've gotten everything done.
Yeah, that's a good point. I would just add as well to Alan's point around the exit plan for a property for a bridge loan. If we see that a sponsor is planning to renovate a property and then ultimately take out the property with a permanent loan once it's renovated, stabilized, and leased up, there we want to ensure that our loan has a takeout at maturity. So we'd be underwriting, as Alan said, the stabilized income to ensure that it will qualify based on projected income for a takeout loan there. In terms of scenarios, Alan, that you've seen for your clients, what do you typically see for sponsors to get the very best terms that we could offer there?
Yeah, so when we look at scenarios, generally speaking, when you see a light rehab with an experienced investor with high FICO scores, that's where we're going to see our best program. So for example, if you have someone that's purchasing a property for $1 million and they want to put in $1.5 million, it's not a loan we can't do. It's just we know that they're not going to probably get that 80% loan to value. That's most likely going to be a heavy rehab. It's going to be, say 75% LTV. The people who are getting the best terms are going to be the clients that are coming in. They're buying a property for $1 million or $2 million, and they're going to put in $200,000, $300,000 in rehab to kind of cosmetically take care of what's going on. And the borrower or the client has, a significant amount of experience, not only in that general area where they're doing the project, but in these types of homes. So, if you have someone that's coming in with, they've only ever done 1 to 4 unit properties, and now they want to do a 25 unit property, it's not to say we can't do it, but there's a lot of risk that goes into that, right? So especially if it's a rehab loan, the rehab loans more specifically, because you now have to start dealing with the municipalities and getting approved plans, getting your permits. If you were just a regular rehabber doing 1 to 4 units, you may not have ever had to deal with any of that stuff. When you have a 5 unit property or a 10 unit property or 25 unit property, the municipalities get a little bit more involved, and they can sometimes be difficult to deal with. For example, you talk about the boroughs in New York City. So, I do quite a few conversions there. Some of the things that we run into are these properties that may have been vacant for, quite a bit of time because they've been run down. There's going to be a lot of violations that are going to come up on title that are going to need to be taken care of, somehow vetted. Some will need to be paid, some will need to be taken care of through the rehab budgets. Those things will come up, and that's something that you all should be aware of, because that does extend the turn time of these projects. These projects aren't going to be projects where you're going to come in and say, hey, listen, I have 2 weeks to close this loan. Can we do it? The answer is going to be no, almost every single time, and it's going to take that much longer just to get the appraisal back. So there are so many different things that go into a good quality scenario. The borrower having 700 plus FICOs always helps. Our minimum is 680, but 700 plus FICOs, it shows that it's a quality paying client. Good experience in these types of projects, good experience in this area, very important, right? If you have someone that lives in New York City, has done all these things in New York City, and now wants to do one in Florida, right? So they don't know the Florida regulations, how to deal with those municipalities. So, then we start asking some follow-up questions while we're vetting it is, who's going to be doing that construction? Are they located in Florida? Is it going to be something that they're going to be able to handle and they've handled before in the past? So, so when you look at your very high qualified clients and projects, it's going to be a small rehab with a very experienced investor in that area with those types of properties and decent FICO scores.
Yeah, I think those are great points. In terms of experience, can you hit a little bit on the experience requirements and how having more experience can also improve loan pricing and leverage?
Yes, absolutely. So all of our pricing and terms are based primarily on the FICO score and the experience of the borrower. Pricing is only on the experience of the borrower. So The higher the experience, the lower the pricing. So when we look at experience, we look at how many investment properties the investor has owned in the last 3 years, whether it be they flipped it in the last 3 years or they still hold it. So it doesn't matter which one it is. If they're doing a fix and flip and they own, 20 properties, they have 20 experience. So, and 20 plus is that's kind of our best experienced level. So what we do is we'll ask for the client the addresses that the clients have owned in the last 3 years. We'll pull them up. We'll make sure that they held title or an entity that they owned held title in the last 3 years. If not, we'll do a little bit more digging, maybe get a HUD or whatever to verify that experience. So when we send that up, so rates right now, I mean, if you're a 10 plus experience, rates are between say 8.5 and in the high 6s right now. So you have an opportunity to buy up and down the rate, whatever you're looking to do. And then obviously your leverage is going to have to do with that as well. So if you're an experienced investor, which would be anybody who's held title on 3 investment properties in the last 3 years, would be considered experienced at RCN Capital. So just 3 is the minimum. Once you get to those numbers, that 3, then your leverage, you qualify for our max leverages. The experience, obviously, as it goes up, so you got 3, 10, 15, 20, your rates and your pricing starts coming down as you become more and more experienced, because obviously that investor is much less of a risk because they know what they're doing. They've done it several times in the last 3 years.
Yeah, and I would just add there, for our 30-year term program, we actually don't have an experience requirement for multifamily specifically. So if you have a client that has never owned a multifamily property, we can actually do that loan. We typically would like to see that they have a third-party professional property manager there, since if they don't have any property management experience or ownership of a multi. And in terms of bridge qualifications for no multifamily experience, we have flexibility there as well, particularly if they own SFR rentals, to show that they do have some experience with investment properties, even if they're not multis. In terms of some red flags that you see up front when you screen deals, Alan, can you speak a little bit to any red flags a borrower or properties may have when you first see deals?
So kind of the biggest red flags that I see are going to be those investors that may be scrambling, right? So we talked about experience. So they might be scrambling around to find other investors to come in and partner with them, or they have very limited experience, but they want to do these heavy rehabs where they want to do a conversion or they want to do a condo conversion. So the biggest red flags that I see is usually around experience. And to be honest with you, like the loans that we see that don't perform as well, those are the ones where maybe we saw those red flags and didn't really vet as much as we should have to begin with. So I think the experience piece of it is extremely important. Make sure you pull up the Google sites and look at these properties when you get them. You're going to see a lot. Take a stroll down the neighborhood, as my CEO tells me all the time. Take a stroll down the neighborhood. Look at the neighborhood. Is what we're doing make sense for that neighborhood? If it doesn't, if your gut tells you something's off here, probably is. So I would say, keep an eye on that experience. Keep an eye on the investor when they're trying to add, some partnerships because maybe they're lacking in some different areas, which is something we can do, as long as it makes sense. But those are usually the biggest red flags that I see, is when the investor starts scrambling to find partners that are going to come in because they have more cash, or they don't have enough cash, they don't have good credit, they don't have enough experience. So they're bringing in some of these partners to kind of help them get the loan over the finish line. These are things that we can do. It's not that we can't do them, but these are red flags that make us ask a few more questions, make us dig a little bit deeper as to why this investor feels like they should be getting involved in a deal if they don't have, a large amount of liquidity, if they don't have the experience in these types of buildings. So those are usually the big ones. Don't walk past the problem, right? If it's there, ask the questions. If you don't feel right, pick up the phone, call us. We've seen every scenario you'll ever want to see. And if it's something, just make sure when you bring that deal to us, you let us know. Let us know. Say, hey, listen, I'm not feeling great about this, and this is why. We've seen it in the past, and it's fine. It's no big deal. Just make sure that you bring those issues to us when you bring that file to us.
I think the last question we had on here was just around the quickest turn times for files. I know you hit on that on the front, Alan, regarding a few extra requirements that you'll see for multi-deals as opposed to 1-4s. Are there any things that you wanted to focus on to get the fastest closings as it pertains to multis?
So transparency is huge. This is going to help you get your quickest turnaround times, is helping that borrower, that investor understand, what's going to happen during the process. The cost behind the reports that we have to get, the time it's going to take to do it. So there's a lot more time that goes into this. The turn time is not like you would see on a 1-4 family. Also, make sure that you set clear expectations around what we're going to need up front. So, with a 1-4 family, we don't need a whole lot, a purchase agreement and a rehab budget. With a multi-unit, we need our rent rolls. We need the rehab budgets. If it's going to be a significant rehab, we're going to need plans or some sort of floor plans in order to get those over to our feasibility company. When they do the feasibility study, they're going to want to see what property is going to look like when it's done. There's a quick, easy form that we have filled out, that we have the investor fill out or the broker fill out for the investor on the project, so that we can see what's going on, the investor, so that we can pre-vet it. And this is something Hunter does for us as a director there. So he pre-vets every single one of our multi-unit properties to make sure that it's not just a broker, an investor, and a loan officer trying to get a deal done, that we're looking at it and saying, not only is this the right loan for or right project for the investor, but is it the right project for RCN Capital as well? So there's a lot of due diligence that goes in it from our standpoint, from a pre-vetting, that if we can get all of that information, you can collect that up front. So when you send it to me, I can get it to Hunter, work it all up, and have an answer back within an hour or two, and we can let you know exactly what we can and can't do on a property. But that's usually the biggest thing, is making sure that the client understands that, this isn't just your typical 1-4 family fix and flip, that this is something that's much more significant, that there's the timeline on this is about 6 weeks, that it's much more costly than doing a 1-4 family. These commercial narrative appraisals, they could be between $2,500. I just saw a quote come over for $6,000 the other day. So it's not a cheap venture for these folks to do. And if you do, going back to red flags, so if you do get let's say you get a $3,000 quote on an appraisal for a commercial narrative appraisal, and your client doesn't want to pay that much money, that should be a red flag, that maybe they don't know what they're doing here, because $3,000 for a commercial narrative appraisal is not that expensive. So those are the types of things that if you can be prepared, knowledgeable, and that's why keeping in touch with your loan officer here at RCN Capital is so important. You know, you'll send us over scenarios. We'll have to ask them additional questions, and then we'll send you, you know, hey, listen, this is what we're going to need to get this pre-vetted and signed off on by Hunter. That's usually the quickest turn time. The turn time that takes the most amount of time is collecting the data from the client. We have no control over how long these appraisals are going to take. The environmentals are very quick. The situs is very quick. Feasibility studies are very quick. As long as the borrower understands that they're going to have to pay that. So when we send a link out to be paid, they pay it right away, and we can get these ordered.
Here we have a few common questions that we sometimes receive for the multifamily program, specifically around the differences between our 1 to 4 family programs and the multis. So we wanted to quickly walk through some of these common questions. The first is around our bridge loan terms. People often ask, what is the exact loan term for a bridge deal that I'm bringing to you? We have a lot more flexibility there than we obviously would on a 30-year deal, which is fixed. We can do anywhere from 12 to 36 months. As Alan mentioned, it really depends on the extent of the project. We want to ensure that on the short side or the long side, that the loan term really makes sense for the deal. So if you have a rehab that's going to take, call it 12 months, and then the project needs to be rented out and stabilized, we definitely don't want to do a 12-month term. We want to give the borrower more time there. Also, if we have a rehab that's only going to take 3 months with, call it a 2 or 3 month lease up time after that, if there's a request for a 24 or 36 month term, we want to ensure why that is, just to understand why they would want to pay a bridge rate fee for a shorter period renovation. The next question that we get is around the draw fees. For our bridge loans, those are $75 per unit, and including the wire fee. For a draw, we can do anywhere from 0 to 9 draws. For a ground up construction multi-deal, it's $599 per draw. The reason for that is that that's for the whole property. So obviously when you have more units, there's going to be more to it there. In terms of the value per unit requirements, we like to see, as we touched on, for our long-term, we like to see $50,000 per unit. For our bridge program, the RTL program, it's $35,000 for an as-is value for properties that need rehab, and $50,000 typically for as-repaired values. In terms of how fast we can close, I think Alan's covered that pretty well already. Typically 4 to 6 weeks, really depending on the extent of the project. For your smaller multis, we can actually use some form appraisals for 5 to 8 unit properties that are sometimes faster. So that will be towards the lower end. For a bigger multi, call it an 8 or 10 million bridge loan, that's going to be towards the longer end of that time frame. In terms of how to estimate values on multifamily properties is another question we often get. For these type of properties, as we've touched on previously, appraisers will really underwrite to the income of the property. So whether it's an as-is appraisal or a stabilized appraisal, they're going to effectively estimate the net operating income of the property. So that's your estimated rents, estimated expenses. And the value is much more heavily reliant on the income of the property versus sales comp. So for a single family rental, appraisers will look to market rents, but ultimately the value is concluded based on the sales comp. Sales comps are included in multifamily appraisals, but are really not used as extensively to actually conclude to the value as you would see with your actual income and a cap rate to conclude to the value. And then lastly, we like to outline a few differences for any kind of new borrowers or brokers to multifamily lending. If they've done a 1 to 4 previously and say are doing their first multifamily deal. Alan, did you want to touch on some of the main differences we typically see from our end for any kind of new investors here?
So on the long term, which is where we really start seeing some new investors around the multi-units, they really do, they're pretty taken back by the process and the cost of a multi-unit property. and again, I go back to my transparency. So when I speak with an investor who's doing a multifamily property for the first time, I go over the process in specific detail. I go over the cost in specific detail. We do a great job at RCN Capital trying to keep the cost down using the least expensive due diligence as we can. For example, when we do an environmental. So an environmental, if you were to go out and get a phase one, I think it's $1,300 for a phase one environmental study. We start off with a small $150 environmental survey. If it comes back low risk, we can stop there. It's fine. We don't have to get anything else as far as the environmental goes. And then we have some other options if it does come back as elevated. So, but the client needs to understand that these things are going to happen. That, the last thing I want to do is have them get a quote from an appraisal, that's $6,000, and not understand that could actually happen. Obviously we go back and we try to find cheaper options, but the process, the timeline and the cost is usually the biggest wow moment for the client, because it is very, very different than what they're used to if they're used to just purchasing 1 to 4 families and holding those or flipping those. So I would say, when you do speak with these clients and you do understand that they've never done it before, that you are the professional, you're the expert when it comes to these. Make sure that they understand that here's what it's going to look like, and it doesn't matter where you go, it's going to look like that anywhere you go. It's going to be more expensive and it's going to take longer. There's no getting around it. So make sure that they understand that, and when they do, your process will go much quicker. Our process will go much quicker, and your loans will close much easier.
I think that was the rest of our common questions we had. I'm not sure if any questions have been submitted otherwise.
Yeah, so we did get a few questions come in through the Q&A. One of them was more so addressed to the 1 to 4 units, but something that maybe we can elaborate a little bit more on is the current rates on the 30-year program for both 1 to 4 units as well as 5+ units. I'm just going to talk about that briefly, and then if you guys want to elaborate a little bit more on it. But currently we are at about 4.5% on these multis and about a 4.475 in terms of the long term for those 1 to 4 units. Really, the thing that I want to emphasize with this is right now with the market, there is a lot of volatility. There's a lot of things changing, not just locally, but around the world that do impact interest rates, not just the Fed increasing their rates. So as we go about quoting this, and this kind of ties back into the transparency that Alan was mentioning earlier, but as we go about quoting these are going to be subject to change. So if we show you a quote based off of some speculative numbers that were provided in the early vetting stage, when we get back that official commercial narrative, if it's going to be a 5+, and when we get back their credit report, those are going to slightly change, most likely, the terms of that loan, but also how our guidelines are at that time may also be impacted. So as we go about trying to price out these loans, as you go relay these terms to your clients, do try to emphasize, especially now since there is so much volatility, that until we can confirm that we've locked in a rate with you, until we have all of the materials that we need to do a rate lock, that these are going to be roughly subject to term or subject to changes as we go through this kind of period of volatility in the markets. Is there anything that either of you guys want to add to on that?
No, not for me.
I'm good.
Thank you, Connor. Were you also able to answer NACS for the long-term rental loan? Were you able to answer that one? Is there a season required for the purchase, rehab, doing it?
Yeah, so I was just about to I just saw that that question come over, and that's a great question. So with 5+ units, there is for the takeout, there is a 9-month seasoning period. So that 9-month seasoning period is not a seasoning period for whether or not we can lend on it. So, let's say you purchase this property, you want to rehab it. You do your rehab, and let's say it takes 6 months for you to do your rehab. Now you want to refinance into long term. So we can do that. What we would do is, if you're within that 9-month seasoning period, we would take and use your total loan to cost. So we would take your purchase price plus the amount of rehab that you put into it, and that would be the value that we would use to lend up. So we'd still be able to do it in most cases. And I think what you were thinking of was it's probably got to be stabilized for 3 to 6 months before they'll refinance it. We don't have that requirement. So if you've had it for 9 months, you've completed your rehab and you want to refinance into a 30-year at that point, we can certainly do that and use the appraised value after 9 months. I hope that answered your question.
Good, very good. I know there was a couple questions on chat as well, but I'm going to say to Knack, I see your name as Knack here. By all means, I put down Connor's email address, Hunter's email address, and Alan's email address. And I know you said you have a property in Colorado, and you also have a property out in Texas. By all means, send those that information out to Alan and Hunter and Connor, and they'll give you an answer back right away. Someone also mentioned about the video, and yes, by all means, allow us 2 days. We'll have an edited video out right away, and also a thank you letter from Erica from RCN that will also give you the information on how to contact Hunter, Connor, and Alan over here. Of course, you see their email addresses here. In the chat, there's also the email addresses. So if you need to reach out to them immediately, then you can copy those email addresses and send an email to them right away. Guys, thank you. I thank you very much. We're going to have another webinar from you in May. That's going to come soon. Hold on. I just want to make sure I answered all these questions. Thank you. I love to connect today. All right. That's Knack. Knack's going to reach out to you guys. Just want to make sure if we answered everything. That's about it. Guys, anything else you want to say before we conclude?
Yeah, just thank you very much for having us on. We do really appreciate it. It's nice getting to see you again, Anthony. It's been a little while.
Yes, by all means.
Yeah.
Yeah, but also, if anybody does have any questions, even if it's something that they're not entirely sure if it's really in RCN's wheelhouse, reach out to us. We'll let you know if it is something that we can or can't do. If it is something that we can do, we'll let you know if we need any more information on it. We'll try to give you some rough pricing, maybe let you know a couple of other things that we still need information on. If it's something that we can't do, then, well, we won't be able to help you with that. But what we might be able to do is reach out to some of the other contacts that we've established in the industry. We'll see if we can find a nice pair to help you get that loan at home.
Thank you, Connor. Guys, we also have a couple more things coming from RCN, just so there's heads up. There will be another webinar. It will be at our virtual expo in May. We have 2 virtual expos, one in May and one in November. There will also be what's called something brand new that we're offering. It's a CEO presentation, and Jeffrey Tesh from RCN will present. He will be actually presenting that recorded version of what happened in 2022 and what his visions are in his industry, what's going to happen in 2023. That will be aired in December. And then I believe Eileen, Connor, how you pronounce Eileen's last name again? Eileen
Maza.
Maza. So Eileen will also be doing what's called a web talk. That's something new that we're doing here. Instead of an hour webinar that we're offering, Eileen will speak for about 20 minutes to a live audience. Everybody's picture will appear. It's almost like a live chat room, and people will be bringing deals to Eileen about the RCN products. So that's something brand new that we're offering. So we will see RCN 3 more times before September. So ladies and gentlemen, I just want to say thank you. And this concludes the RCN webinar. And once again, Alan, Hunter, Connor, thank you. Thank you very much.
Thank you, Anthony. Good to
Thanks very
see you
much.
again.
Thank you
Yeah.
very much.
Take care, guys. Be well. Bye-bye.
Thanks, you
Thank
too.
you, audience.
You as well.
Thank you, everybody.